right now, millions of people taking weight loss injections like Ozempic and Wegovy, they're basically altering the trajectory of the human lifespan.
Yeah, they really are.
But the place where that massive biological shift is actually showing up first. It isn't just in medical journals. It's actually on the bottom line of a 150-year-old insurance company.
Right. It's a perfect example of how broad societal shifts, whether we're talking public health, artificial intelligence, geopolitics, they eventually translate into hard data. They always show up in the math.
Exactly. So welcome to this deep dive. Today we are opening up the Q1 2026 earnings call of MetLife Inc.
Yes.
And normally, when you hear earnings call transcript, you might brace yourself for this avalanche of Wall Street jargon, but we're avoiding that today.
Yeah, we are completely stripping away the financial speak because our goal here for you listening is to use this raw transcript as a lens.
It's a sort of shortcut.
It's exactly a shortcut.
Yeah.
Because if you know how to read them, these documents are basically a map to understanding the hidden macroeconomic forces shaping the world you live in right now.
Right. We're going to connect the dots between MetLife's ledger and the broader global economy. And to do that, before we even look at the specific insurance products they sell, we really have to look at the engine running this massive operation.
The efficiency of the machine itself.
Right. So in this quarter, MetLife reported a staggering $1.6 billion in adjusted earnings.
Which is up 18% year over year, by the way.
Up 18%, yeah. And one of the first metrics that jumped out at the top of the call was their return on equity, which hit 17%.
That's a big number.
Right. But for those of you who don't spend your days on a trading floor, what does that 17% actually tell us?
Okay, so return on equity, or ROE, is basically a measure of how efficiently a company is using shareholder money to generate profits.
Okay.
So if you give a company $100 and they generate $17 of profit with it, that's a 17% ROE.
Makes sense.
And in the financial sector, especially for a heavily regulated, super capital-intensive business like insurance, hitting the top of your target range at 17%, that's a very strong signal.
Right.
It tells you the machine is humming perfectly.
Okay, so the machine is highly profitable, but the metric that really seems to prove that efficiency was something called their direct expense ratio.
Yes, the expense ratio.
I know it dropped to 11.9%, which beat their own full year target of 12.1%. But what exactly is a direct expense ratio measuring in this context?
Think of it as the company's operating budget compared to its revenue.
Like overhead.
Exactly. It measures how much it costs them to just keep the lights on. Pay employees, maintain software, run the actual offices relative to the premium they're bringing in.
Got it.
So lower is always better. Dropping it to 11.9% means they're spending less than 12 cents on operational overhead for every single dollar of revenue they manage.
Okay, and this is where I need you to help me understand the mechanics of this. Because there's a detail in the transcript that makes that 11.9% seem, well, completely counterintuitive.
The PineBridge integration.
Yes. So MetLife recently integrated this company called PineBridge, an asset management business. And from my understanding, asset managers structurally have way higher day-to-day operating expenses than traditional insurance.
They absolutely do.
So it's like they bought a gas-guzzling sports car, bolted it onto their factory, but their overall fuel efficiency somehow went up. How does an old-school institution pull that off?
It's a great analogy. You would totally expect the overall expense ratio to go up. But the reason it didn't lies in a very specific number the CEO, Michelle Halaf, brought up on the call.
Okay.
$3.2 billion. Over the past 5 years, MetLife has quietly invested $3.2 billion to completely overhaul and modernize their technology ecosystem.
Wow.
Yeah. They've been systematically embedding artificial intelligence across their core operations to reduce complexity.
Okay, but I want to push back on that a little bit because, every company right now claims they're embedding AI. Is this just them, installing some fancy chatbots on their customer service page to save on call center staff?
No. It goes much, much deeper than front-end chatbots. It's about fundamentally rewiring how risk is assessed and how claims are processed.
Give me an example.
Okay, let's look at the mechanics of a traditional insurance claim. Historically, a customer submits a medical document, usually a messy, unstructured PDF from a hospital.
Right, a total nightmare to read.
Exactly. And a human associate has to open it, read through the text, find the specific billing code, cross-reference it with the customer's policy limits, and then manually approve or deny it.
Which takes forever.
Right, that process might take 20 minutes per claim.
and requires an absolute army of people if you have millions of customers.
Exactly. But when you embed AI deeply into that core system, the AI can instantly read that unstructured PDS. It extracts the data, structures it, verifies the policy rules, and flags it for approval in like 3 seconds.
Wait, 3 seconds?
Literally 3 seconds. The human associate only steps in for complex edge cases. So when you apply that level of automation to a company serving over 100 million customers globally,
we're saving a fortune.
Yeah, you start shaving off fractions of a penny and minutes of human labor on millions of transactions every single day.
So they basically built an underlying intelligent infrastructure that's just so incredibly efficient, it easily absorbed the high costs of the PineBridge acquisition without breaking a sweat.
Precisely. And efficiency at this scale is what creates a high-quality compounder over time. They aren't just aggressively cutting costs by firing people. They've built a system that fundamentally does more with less.
Meaning more of the revenue bypasses the operating expenses and drops directly to the bottom line.
Exactly.
That makes a lot of sense. So the technological engine is highly tuned. But if the tech is running that smoothly in the background, let's look at what is happening with the actual people they are insuring.
The human element.
Right, because this is where the transcript gets incredibly relatable for anyone listening. Let's look at their group benefits segment. This is the workplace insurance, life, dental, disability that a lot of you probably have through your employer.
Right, and the group benefits segment had a phenomenal quarter. Earnings hit $439 million, which is up 19% year over year.
Huge chump.
Yeah, and a massive driver of that profitability was their group life mortality ratio, which came in at an exceptional 80.1%.
Okay, I'm assuming lower is better here, right? Because it means fewer people are passing away.
Yes, lower is absolutely better. Their target range was 83 to 88%.
Oh, wow.
So to hit 80.1% means significantly fewer people passed away than their actuarial models predicted.
Got it.
Actuaries build these complex models based on historical data to predict how many death claims they'll have to pay out in a quarter. When the actual number comes in that far below a prediction, it creates a massive profit margin for the insurer.
Now, part of that was just a light flu season, which makes sense. But the management team specifically called out highly favorable mortality trends among the working age population.
Yes, they did.
And their explanation for why this is happening is what absolutely stopped me in my tracks. They noted 2 things. First, a post-COVID pull-forward effect.
Right, and it's a pretty somber reality of the data.
Yeah.
The pull-forward effect means that, tragically, many highly vulnerable individuals who might have statistically passed away this year or next year passed away prematurely during the height of the pandemic.
Right. So the current pool of insured individuals is, on average, slightly healthier than the historical baseline.
Exactly.
But then they mention the second factor, the rising impact of GLP-1 weight loss drugs. I mean, are we really at the point where prescriptions for drugs like Ozempic and Wegovy are literally moving the bottom line for a global macroeconomic giant?
We are absolutely seeing the early evidence of it, yes. What's fascinating here is if we think about the mechanism of how these drugs work, they aren't just suppressing appetite for cosmetic weight loss.
Right, it's systemic.
Exactly. The clinical data increasingly shows they have profound downstream effects on cardiovascular health, reducing the severity of sleep apnea and improving overall metabolic function.
And those are the big killers.
Right. Heart disease and metabolic issues are massive drivers of premature mortality in the working age population.
So people taking a weekly injection to get healthier is directly showing up as fewer premature death claims, which translates to windfall profits on a Wall Street earnings call.
It really does.
But wait, if human beings are just fundamentally living longer because of these biotech breakthroughs, shouldn't MetLife just keep making record profits forever?
Well, that's the logical assumption, right?
Yeah.
But it ignores the mechanism of a free market.
How so?
The insurance industry is fiercely competitive. So right now, sure, MetLife is enjoying the spread between their old pricing models and the new, healthier reality.
Okay.
But over time, as these new mortality trends become what we call actuarially credible.
Meaning there's enough hard data.
Exactly. Meaning there's enough multi-year data to prove this is a permanent biological shift and not just a one-year blip. Once that happens, their competitors will start lowering premiums to win corporate clients.
Ah, so to win a contract with a big employer, an insurer will say, hey, your workforce is healthier now. We can offer you a cheaper rate.
Spot on. If this health favorability persists, it eventually flows back into cheaper pricing for the customers. But as management noted, it takes years of data to definitively reprice those risk models. It happens over years, not quarters.
Okay, so long-term life insurance premiums might actually go down. But what about the flip side? What happens when people get sick or need time off? Because in their disability business, they actually saw higher upfront claims. Were people getting sicker?
No. The underlying health didn't deteriorate there at all.
Oh.
The spike in disability claims was entirely driven by regulatory changes, specifically new state-mandated paid family leave programs.
Right. More states are legally requiring companies to offer paid time off for a new baby or, to care for a sick relative. How does that impact MetLife's models?
When a state launches a brand new paid leave benefit, it creates what actuaries call a front-loaded claim pattern.
What does that mean?
Think of it like a city opening a brand new commuter bridge. For the first few months, everyone drives on it just because it's there, and traffic spikes artificially high.
Okay, I see.
When a new paid leave program goes live, there's a sudden surge of employees who've been waiting to take time off, and they all file claims at once.
But that traffic eventually normalizes, right? Once the novelty wears off and the backlog is cleared.
Precisely. It normalizes over time. And importantly, MetLife can reprice about 50% of their disability contracts every single year.
Oh, wow, that's fast.
Yeah, so if a new state law causes a permanent uptick in claims, they can very quickly adjust the premiums they charge employers to reflect that new regulatory reality.
So we are seeing how they adapt to American workplace and health trends, but MetLife is not just an American company.
Not at all.
They are a massive global player, and when you look at their international results, it really highlights how this machine buffers against chaos in any one country. Asia had an unbelievable quarter.
Incredible quarter.
Earnings were up 31% to $487 million.
The growth there is remarkable. Japan, which is their largest market in Asia, saw sales rise 26%, and Korea skyrocketed 44% due to a strong macroeconomic environment and rising equity markets.
But the underlying driver of that growth was really interesting to me. A massive chunk of those sales in Japan and Korea were US dollar-denominated products.
Yes.
Like Japan had a 50-50 split between yen and US dollar policies.
Right.
Why would a consumer living in Tokyo or Seoul want to buy an insurance policy priced in US dollars?
It comes down to interest rates and yield. If you're a Japanese consumer, your local interest rates have historically been near zero for decades. If you buy a policy denominated in yen, the yield on that policy, the growth of your money, is going to be very low. But U.S. interest rates are significantly higher.
So it's an investment play for them.
Exactly. By purchasing a policy denominated in U.S. dollars, the Japanese consumer can tap into the strength and higher yield of the U.S. financial system.
And for MetLife, why is that such a good deal?
Oh, it is a brilliant global hedge. It allows MetLife to drive immense product demand in a foreign market without taking on the risk of local currency fluctuations.
Because they're doing everything in dollars anyway.
Right. They are collecting premiums and paying out claims in the global reserve currency. It completely insulates them from local macroeconomic shocks in Asia.
Okay, let's unpack this a bit more, because speaking of shocks, I do want to ask about a regulatory issue in Japan that was mentioned in the transcript.
The seconded employees.
Yeah. There was some drama regarding seconded employees. MetLife had to take corrective actions, discontinue the practice, and return employees to their original positions. With sales up 26%, is this regulatory slap on the wrist just a speed bump, or is it a sign of growing pains?
It's an important detail to clarify. Seconding essentially involves an insurance company temporarily assigning its own employees to work at a partner distributor, like a local bank, to help drive sales.
Oh, okay.
The Japanese Financial Services Agency recently decided they didn't like this practice, feeling it blurred the lines of impartial distribution.
So they stepped in and said, stop.
Yes, but what is crucial to understand is that this wasn't a MetLife-specific scandal.
It wasn't.
No, it's a pervasive, industry-wide practice in Japan. Everyone was doing it. The regulator issued a warning to the entire industry. MetLife immediately did a comprehensive review, unwound the practice, and complied.
And their sales still went up.
Exactly. The fact that their sales still grew 26% while dismantling that distribution tactic proves that their underlying consumer demand is organic. It wasn't artificially propped up by those seconded employees.
Okay, so they navigated the Japanese regulator smoothly. But what about true geopolitical shocks? When we look at EMEA, Europe, the Middle East, and Africa, with everything happening in the Middle East right now, I fully expected to see a major hit to their earnings.
Right, a lot of people did.
But earnings there actually rose 33% to $110 million. How are they dodging that instability?
It comes down to geographic reality versus the news headlines. When we hear Middle East, we assume massive regional exposure.
Sure.
But MetLife is highly insulated by their geographic mix. 2/3 of their EMEA earnings actually come strictly from Europe.
So the bulk of it is totally removed from the conflict zones.
Exactly. And of the remaining third that represents the Middle East and Africa, about half of that exposure is concentrated in just Turkey and Egypt.
So they just aren't physically in the hot zones.
Right. Their actual footprint in the active conflict zones is immaterial to their global bottom line.
Yeah.
Now, they're closely monitoring it and prioritizing employee safety, but it's not a financial drag.
The transcript also noted they made the difficult but resilient decision to divest their business in Ukraine.
Yes, they passed ownership to a new regional parent company that is better positioned to continue operating it under those incredibly challenging, tragic circumstances.
Got it.
It shows a highly pragmatic, unsentimental approach to managing their global portfolio risk.
All right, so MetLife is collecting billions of dollars in premiums globally, US, Japan, Korea, Europe. But they don't just put all that cash into a giant corporate checking account.
Definitely not.
What exactly are they doing with that mountain of money before they have to pay it out in claims?
They invested. I mean, this is the absolute core mechanism of the insurance business model. It's called managing the float.
A float, right.
You pay your premium today, they might not have to pay your claim for 20 years. In the meantime, they invest that cash. And this quarter, their variable investment income, or SEVIN, was massive. $518 million pre-tax.
Now, when we look at how they invest, they have a massive $85 billion private fixed income portfolio. And I noticed management spent a lot of time assuring Wall Street how boring and conservative it is.
Oh yeah, they leaned into that heavily.
They pointed out that 95% of it is investment grade, zero exposure to business development companies. Under 1% is in middle market loans. Basically, they're shouting from the rooftops that they aren't taking crazy risks with the bulk of the float.
And they have to shout that because their primary job is solvency. That $85 billion is the bedrock. They take those safe, highly predictable long-term investments and match them against their long-term insurance liabilities.
Right.
They need to absolutely guarantee the money is there when you need it.
But the safe stuff doesn't generate massive returns. The transcript showed that where they are really making their money is in these smaller alternative buckets.
Yes, this is where we see the classic barbell strategy of investing.
How does that work?
On one end of the barbell, you have 95% of your money in extreme safety. On the other end, you take a small, highly controlled sliver of your capital and take aggressive, high-growth risks.
And the high growth risk is paying off. I mean, their private equity investments returned 2.9% for the quarter. But their $3.5 billion venture capital portfolio generated a massive 6.8% return in just a single quarter.
It's a huge return.
And management explicitly stated this is because that specific VC portfolio is heavily skewed toward artificial intelligence firms that are seeing skyrocketing valuations.
It is a striking reality. They aren't just writing boring bond checks.
No, they've essentially built a Silicon Valley VC firm inside an insurance wrapper.
That's a perfect way to describe it. By carving out this small venture capital allocation, an old-school life insurance company is capturing the massive upside of the Silicon Valley AI boom. And they're doing it entirely without risking the core solvency of their policyholders.
But there was one investment move that initially confused me.
What was that?
So the MetLife Investment Management arm, which they call MM, opportunistically, sold off $750 million in private equity assets in the secondary market.
Right, the PE sell-off.
And they admitted they sold them at a modest discount. I mean, if their alternative investments are doing so well, why on earth would they sell a massive chunk of private equity at a discount? That sounds like a terrible trade.
On the surface, it absolutely does. But when you look at the mechanics of the deal, it is a masterclass in long-term strategic thinking.
Explain that to me.
They didn't just sell the assets and walk away. The transaction was specifically structured so that MetLife Investment Management continues to manage those very same private equity assets for the third-party clients who just bought them.
Wait, I need an analogy here. Is it like selling an apartment building to an investor, but writing a contract saying you get to be the paid property manager for the next 10 years?
That is exactly it. Spot on. They sacrificed a tiny bit of upfront yield on the sale price to secure a long-term recurring stream of management fees as an asset manager.
Oh, wow.
Yeah, they're transforming assets that were tying up their own balance sheet into an ongoing revenue stream that lives on someone else's balance sheet. It fuels the growth of their entire third-party asset management business.
Okay, that is fascinating. So we see how they make the money with the AI efficiency engine. We see how they invest it through the barbell strategy. How does this all ultimately translate to the financial health of the company? And what corporate drama is lurking in the shadows here?
Well, financially, it translates to immense liquidity. In Q1 alone, they returned $1.1 billion to shareholders.
Wow.
Yeah, they bought back $750 million in stock, paid out $370 million in dividends, and they actually increased their dividend by 4.4%.
And they're just sitting on $3.9 billion in cash at the holding company. Plus, they went to the market to issue $1 billion in subordinated debt, and investors lined up to buy it. It was oversubscribed 5 times.
Which is incredible.
Now, what makes debt subordinated? And why does that oversubscription matter so much?
Subordinated debt is essentially a riskier type of bond. If a company goes bankrupt, the subordinated debt holders are further back in the line to get paid out compared to senior bondholders.
Okay.
So if eager investors are oversubscribing a subordinated debt offering by 5 times, they are screaming their absolute confidence in MetLife's balance sheet.
Right.
They're saying, we have zero fear that this company is ever going bankrupt, so we will happily take the slightly riskier debt to get the yield.
And when you have that level of market confidence and billions in cash, you operate from a position of immense strength. Which brings us to the spicy drama and really the most entertaining part of the earnings call.
Yes.
Because here's where it gets really interesting. You don't usually see CEOs throwing punches on earnings calls.
No, you really don't.
Right.
But the situation with Sun Life escalated publicly.
Right. So Canadian insurer Sun Life recently settled a class action lawsuit. And in their public press release about the settlement, Sun Life claimed that MetLife actually owes them 200 million Canadian dollars as an indemnity.
Yes.
When asked about this on the call, Michelle Halaf, MetLife's CEO, explicitly called the claim baseless and misleading. He pointed out that MetLife wasn't even a defendant in the lawsuit, there are no legal proceedings against them, and said Sun Life alone is responsible for its own actions. Why are they being so aggressive publicly?
This is precisely why that financial moat we just talked about matters. When you are sitting on a $3.9 billion cash buffer and you have investors lining up to hand you another billion, you have supreme capital confidence.
You can throw your weight around.
Exactly. A weaker company might quietly try to settle a $200 million claim just to make the negative headline go away. But a company with MetLife's liquidity can afford to publicly, aggressively brush off a claim from a rival because, financially speaking, they are virtually untouchable by a threat of that size. They can stand their ground.
This has been such a wild journey. We started by looking under the hood of a traditional 150-year-old insurance giant. And what we actually found was a company pouring $3.2 billion into AI to build an efficiency engine.
All right.
We found that the biological success of GLP-1 weight loss drugs is directly extending human lifespans and boosting their profits. We saw them hedging against global chaos with the US dollar and acting like a Silicon Valley VC firm to cash in on the AI boom.
It really drives home the point that earnings transcripts are so much more than dry spreadsheets. They show us the exact mechanisms of how massive macroeconomic waves actually crash on the shores of real businesses.
So after unpacking all of this, what is the big takeaway you are left with?
I'd leave you with this final thought to mull over. We've seen today that insurance companies are essentially the ultimate historical aggregators of human data.
Right. They model everything.
Exactly. For a century, they could predict the future by simply looking at the past. But we are entering an era of rapid simultaneous acceleration. If artificial intelligence completely rewrites the speed of knowledge work, and biotechnology like GLP-1s fundamentally alters the physical trajectory of the human body, how will these giant institutions even assess the very risk of being human over the next decade? The past might no longer be a reliable model for the future.
Can the supercomputer adapt faster than biology changes? It's a fascinating question. Thank you so much for joining us on this deep dive into the hidden forces shaping our world. We'll catch you on the next one.